Okay, so we are in the last section or lecture of how to make different ways to make money investing in real estate. So in this lecture, we're going to talk about buying and holding properties or basically managing rental properties. So the this is like the tried and true way of building wealth with real estate because real estate goes up over time and you can actually leverage it in so many different ways when you are holding that real estate. Okay, so this is what we call buying and holding or rental properties as a strategy. Okay, so let's define it. Okay, this is the art of buying distressed properties for low prices, fixing them up, and then renting them out for cash flow or a profit. Okay, equity growth over time and mortgage pay down. So let's break down those three different things, right? Cash flow is basically how much you make at the end of the month after you pay all of your expenses related to that property. So what are some of those expenses that we're talking about? So let's say your rent on a property is $1,000, and let's say your mortgage on that property is $200 a month, and let's say your taxes are $100 a month, and let's say your insurance is $100 a month. So that's $400 right there that you got to take out of your cash flow or your rent that you get every month. And what you are left with is your cash flow. So there are different expenses related to properties, and we will get into that once we start talking about the nitty-gritty details on buying and holding investment properties, which is my preferred method for building wealth and making money in real estate. I also like doing flips here and there, but my primary strategy and what I will be teaching you the most about in this course applies to you building wealth through buying and holding rental properties. All right, so we're talking about cash flow. Now let's talk about equity growth. What is equity growth? So over time, and this is tied to mortgage pay down too. So if you got a renter in your property, right? That renter is paying you every month. You're going to make a profit off of that payment. You're going to pay down your mortgage with that money that they give you. And at the same time that you're paying down that mortgage with that rental income, the value of the property over time in the long run should be increasing. So that's if you buy in the right area, but most real estate, no matter where it is, most of it in the United States at least, has gone up over time. Now we might have dips and valleys in that appreciation curve, but over time it goes up usually from the point in which you bought it. So there are lots of examples. If you look at your parents' house, for example, like where my mom lives now, when they bought that house, I believe they bought that house for about $30,000, if not less, many years ago, of course. And over time, um, now that property is worth probably 10 times that. Okay, it's probably worth $300,000 now. So over time, as you can see, you got equity growth. That's that equity growth. And then mortgage pay down is essentially if you have a renter in your property, they are actually paying down your mortgage, and you pay down the mortgage with that money that they give you. Then you have some cash flow left over to either reinvest or hold on to for whatever, and that also helps. So those are sort of the anchors of the strategy for buying and holding. So, what are some of the key points for buying and holding rental properties? You should be finding properties at good prices in neighborhoods where there is renter interest. And that's key point number one. So you don't want to buy a property where nobody wants to rent or it's hard to rent because it's just going to be harder on you and more stressful. You want to find areas, and that's why I like my strategy has been to target middle class and upper middle class neighborhoods for my rental properties. And I have some rental properties that are lower middle class neighborhoods, and you typically find a lot of renters in a city where you have a decent economy. you'll find a lot of renters in that middle class range from bottom of the middle, to right in the middle to the upper middle class. Okay. And then you got folks that are wealthy or rich people, and you know that's a different market. And then you got people that are below little middle class, where you start seeing a lot of people that they call slumlords or Section 8 investors and that kind of thing. And that's a different market as well. So what I recommend is to try to find where you will have the easiest time finding renters, and that is the middle class. So key point number 2 is managing contractors and your rehab budget. So when you buy a property, you want to not only buy it for the right price, for a good price, you also want to be ready to do the rehab on the property so that you can have a good product. Once you do that rehab, then you can rent it out, and the better the rehab, the faster you will usually rent that out. So but you also have to be able to manage that rehab and the budget, because typically, if you're going to get a good deal, it's going to need rehab. That's just part of the game, and it's nothing to be afraid of. You just got to start building up your network of contractors, and have the confidence to negotiate and price shop around and get things done. Number 3, knowing how to price the property right. So there's some tools that I will show you later on in this course, where you can actually go online and figure out the average price for a rental property. And then you want to do that before you actually buy the property, so you can calculate your return on investment every month based on how much rent you should be able to get for that property once it's rehabbed and put on the market. So knowing how to price that property right. Also, number 4, knowing how to evaluate a deal and then estimate monthly and annual return on investment to ensure profit. So I'm going to show you how to do that in this course. I have some videos where I actually broke that all the way down, and you will see that once we start getting into the nitty-gritty of strategies to execute on when you are managing your own rental properties. Now, in this section, I'm just showing you the main ways that you can make money with real estate, with buying and holding being one of those ways. So, what are some of the pros to buying and holding properties? Pro number 1, monthly cash flow. Like, one thing that I really like about rental properties is I always have like money on hand. I always have cash. I'm able to, and it's good because I have 2 kids. I'm divorced, and the kids always need something, and I have cash from my rental properties that I can take care of whatever my kids need, that just might pop up, so I don't have to go write a check. I don't have to pull out my credit card every time or anything like that. I got cash. That's your cash flow. All right. And it's nice because usually you want to keep as much of your cash flow, just build it up and save it, because sometimes you have to make repairs on rental properties. So you don't always want to just blow that money. If you got an extra $500 a month, you don't want to spend that 500. You want to save it in case something goes wrong, and then at the end of the year, you got, how much money did you make on that property? You got it sitting there, and it's extra income, and you can make some decisions at that point. So that's pro number 1. Another pro to buying and holding properties is the renter pays off your mortgage, or pays down your mortgage as long as you have one. So eventually, if you hold a rental property long enough, you have your renters in there paying you rent every month, you could just put that rent towards your mortgage and pay down your mortgage. And eventually, when that mortgage is paid off, you are going to be making more profit every month off of that investment property. Now, another thing, property values rise over time, and sometimes dramatically, creating the opportunity for you to cash in. So you might start out with the intention of buying and holding, but then you realize the market goes crazy, like it's kind of at that point now, and then all of your rental properties have some crazy work. You might sell a couple of them and cash in. Like, I actually did that. Like, I sold, I had 30 some properties, and I sold about 10 of them, if not more, and I paid off the mortgages on most of those rentals that I had, so that my monthly income could be greater, and I have less responsibility and less houses that I have to maintain. And so I cashed in that way. Okay. So another thing with buying and holding, this is very significant and serious. I'm not going to go into too much details because I don't want to pretend to be a tax advisor or a tax accountant because there are professionals for that. But there are significant write-offs that you get from holding rental properties or investment properties, significant tax write-offs. You can expense things. So for example, if you pay a contractor $500 to fix something in the house or build something in the house or improve that house, that entire $500 is a tax write-off. The interest that you pay on your loans or your mortgages on your rental properties, that interest is a tax write-off as well, and that adds up. Also, something crazy about buying and holding properties is that they are depreciable. So there's a tax write-off for depreciation on houses, even though they are appreciating in value over time. It's just something that the tax code in the United States allows for that you should definitely consider when applying this strategy because it's just another positive. Another one is it's not as risky as you might think if you're patient and financially prepared. So one thing about rental properties, when I say patient and financially prepared, you got to be patient because the market can go up and down while you're holding that property. Now, if you're in a good economy and people have jobs and there's a demand for housing, even with that market going up and down, you're going to have renters. Like I'm in Columbus, Ohio, we have a great economy. The real estate market goes up and down, but I always have people that want to rent. And part of my strategy is that's why I try to make my house the nicest house in the neighborhood so that I can charge the most rent and rent it out the fastest. Okay. So if you're patient, it's a great strategy because you're constantly getting money to come in, pay off the mortgage, then your money increases, or you can even sell it later on down the road. And then when I say it's not risky if you're prepared financially, what I mean by that is you have money saved up to handle any repairs that pop up or any rehab that you might have to do after a tenant tears a place up and that kind of thing. You have to be prepared for that. And so it's not risky if you're prepared. Now, if you're not prepared and you don't have money sitting around to handle when you get a bad tenant and they mess your place up and you got to spend $3,000 fixing it up and you're not prepared for that, then it could be risky. But if you are prepared for that, you know that if you spend that $3,000, you're going to make it back and even more over time. All right. So another pro is that there's more creative ways to find tenants now than ever before because you got the internet. So you can actually post your advertisement for your house for lease on Craigslist, on Zillow, Rent.com, even put your property on Airbnb to make money if you need to. There's just more ways to find tenants now than ever before, which is definitely a pro. And your net worth builds up quickly when you are holding real estate because the value of the real estate can go up, your mortgages can go down, and you're getting those tax write-offs, but man, your net worth can explode. So that's kind of the story for me. When I started my YouTube channel and I bought the Lamborghini, it's because my net worth was looking pretty healthy because of my investments in buy and hold rental properties. Now, what are some of the cons of buying and holding? So one, money can be lost if you overpay for a home or you sell it too quickly. Now, me personally, I prepare myself for the worst case scenario, by having some cash reserve, for handling different scenarios. And then I don't sell if I'm going to take a loss. I just keep my house rented out. Okay. And the other thing is, if you overpay for a rental property, it can take longer for you to get in the positive as far as your net worth or as far as the value of that property or even the equity in that property. Okay, if you overpay. So you got to be careful that when you start buying rental properties, you want to buy them at the right price. You want to buy them below market value. And sometimes it's okay if they're really messed up and you just need to do some repairs so you can maximize the value. Another con is profits can get cut significantly by getting the wrong type of loan. So a lot of times people get adjustable rate mortgages, which are ARMs, And after a certain amount of time, your mortgage rate or your percentage and your interest that you have to pay can go up or down depending on the financial market. So, or the prime rate is what they call it. So, if the Fed raises the rates, the interest rates for the banks, then what you have to pay the bank in interest can go up on a year-to-year basis usually, or sometimes it's even more frequent than year to year. It can be every month for in some cases. So you got to be careful if you don't get a fixed rate loan. If you get an adjustable rate loan or mortgage, then it can eat into your profits when those rates go up. So you got to be careful if you have rental properties with adjustable rate mortgages. You got to be careful to try to pay those down quickly so that you don't all of your profit doesn't get eaten up by interest when mortgage rates go up. Now sometimes it also works where mortgage rates go down and you pay less interest and you make more profit on your rental every month. But you just got to be careful and cognizant of that or aware. Okay. Also, with one of the cons is budgets and expenses need to be monitored carefully to ensure maximum profit. Um, I think that goes without saying. You just got to be on top of all your expenses. You can't just assume everything is always going to go as planned. You have to be prepared for anything that can pop up. Now, buying and holding properties is not a get-rich-quick scheme. You actually have to be patient. Sometimes you get lucky and the market turns around quickly, but quickly for one person could be slow for another. Like for me, when I bought my rental properties, it was like 2010. I started buying. We're now in 2018. That's 8 years. Now, for me, 8 years has gone by extremely fast, and but my portfolio and the value of those properties has skyrocketed. It's gone up dramatically. And to me, that's a relatively short period of time or a fair period of time for a long-term strategy. So, um, but for other people, that's just way too long, right? They might want to be getting, you might want to get your return on investment within months. So you should be looking at flips if that's the case. But if you're trying to build like a retirement strategy or a long-term strategy, we're talking years and years of equity buildup, of paying down the mortgage, things like that for the rental property strategy to really kick in and for you to become wealthy. Now, sometimes dealing with emergency issues that affect your clients or your tenants can be very stressful. So, like the biggest one that I've seen is plumbing. Like people mess up their plumbing because they're stuffing stuff in the sink, um, and then you got to call a plumber and they got to snake it out, or a water leak comes up or something like that, and you got to call a plumber. That stuff can get expensive, and not only can it get expensive, but it can be stressful because you could have tenants, depending on their attitude and personality and how handy they are, they could be freaking out, calling you and panicking over something really minor. So that sometimes can be stressful. So these are some of the cons that I'm talking about. Now, overall, I still wholeheartedly, despite these cons, I'm just laying them out here for you. Despite these cons, I am still extremely happy that I started to invest in long-term rental properties. And the numbers speak for themselves because I'm going to show you some of those numbers for my properties later in this course. So just stay tuned. Now, unexpected expenses always happen, so you always need to have an emergency fund. That just goes without saying for rental properties, but I'm going to say it. And some people might consider that a con because once they're done with the rehab, maybe they just want to be done and get their money. So you might prefer to be looking at flips in that case. But with rental properties, like I said, it's a long-term strategy, but it's a great strategy for building wealth because your investment can multiply over time. All right, so that is all I have for this lecture. But I just wanted to let you know that in this course, I'm going to focus mostly on the flip strategy and the buy and hold strategy. But there's going to be a lot of things that I teach around evaluating properties so that if you don't start with doing flips or you don't start with rental properties, you're still going to learn things. Like the most valuable thing that I think people are going to learn is how to conservatively evaluate properties so that you know if something is a good deal or not so that you can take action on that deal and maybe get a part of the money in all of those different ways that I just explained in this section on how different ways to make money with real estate. So if you know how to evaluate good deals and know a good deal when you see it, all of these ways that I just talked about, you could execute with one particular property. You could come in as a wholesaler and wholesale that great deal. You could come in as a lender, like a private money lender, and lend the money on that deal. You could come in and buy that deal yourself and flip it, or you could come in and buy that deal yourself and rent it out. I mean, you could just apply all those things, but you got to know how to evaluate deals. So I'm going to focus a lot on evaluating deals in this course, but I wanted to get this out of the way as far as explaining to you the main or popular ways to make money investing in real estate. So wake up, got a lot more to learn, and I will see you in the next lecture. Thanks.